Singapore's November core inflation dropped to the lowest in 3 years, but analysts say price levels are expected to remain high for next year. Market observers expect inflation to ease to a healthy rate of 2% in 2025. Nasyrah Rohim with this report.
Private economists surveyed had expected November's core inflation to hit about 2.1%. The actual data surprised the market, and analysts say the year will end on high spirits.
I'm still anticipating and expecting that inflation will stay below 2% for December, while there's been some holiday spending, but I think it's also mitigated by the fact that there's also some holiday travel abroad. So that's perhaps going to dampen some of the spending momentum in Singapore in the near term.
Headline inflation, which includes accommodation and private transportation, picked up slightly to 1.6% on year from October's 1.4%. That's mainly due to the private transport prices falling at a slower pace of 0.7% compared to the 2.5% decline in October. Car prices saw smaller decreases. This segment could help moderate inflation further next year.
It's expected to improve both as more cars get deregistered, and then at the same time we will have a larger supply that's going to be coming up with some slight growth and some tweaks to the policy going forward. So that could mean that with a greater supply, prices stay capped.
Food inflation has eased to 2.4% from the 2.6% in October, but conflicts in the Middle East and harsh weather conditions could push it back up. You may have noticed that the prices of your recent purchases have been higher than they used to be before the pandemic. Some analysts estimate about a 20 to 30% increase, and that's because of the rapid rate of inflation over the past few years, with it even averaging 6% in 2022. So prices may remain high while inflation eases next year. Analysts say prices will stabilize with the easing, bringing some reprieve for consumers.
And for more on what the latest CPI figures mean for the year ahead, we speak with an economist. Suan Teck Kin is head of research at UOB. Mrs. Suan, welcome to the program. Core inflation finally going below 2% after 3 years. What would be the impact of this?
Well, the impact is that the price increases for those goods that matter to many of us, excluding private transport. I think the pace will be slower. That means even though the price levels are higher now compared to before the pandemic, the increases going forward, I think will be less, with core inflation rate now strongly below 2%. So I think that's a relief and quite reassuring and also comforting for many of us.
Are there still some types of goods or services that are facing stubborn inflation with prices not coming down, Mrs. Suan, and why?
Okay, so we do have some components, for example, medical costs, healthcare costs, and also I think some of the food prices also are still rising at higher than compared to other components. For example, clothes and footwear have been seeing price decreases. So for those going for Christmas shopping, you'll find that your footwear and also for clothing, the prices are not increasing at such a rapid pace. But for food prices and some of these services, for example, medical and healthcare, we are still seeing some fast pace of increase compared to the rest of others.
And despite this, headline inflation has risen 1.6% from 1.4%. Is this a concern to you?
Mm-hmm. Well, I think for price increases overall, this is an overall, Shahida, that you mentioned, 1.6 and 1.4%. I would not be worrying so much about it, because we need to see, or we need to, in general, we are going to see some price increases. As long as these price increases are manageable, are controlled, and not run away like 6% average that we have seen before, I think that is okay. Because I think for companies' points of view, when they supply services and also goods, they also want to make sure that there's some sort of price increases to justify what they're going to invest in future, and also to assure that there is a profit for them. So for consumers, price increases at a controlled level, as long as below wage increases, that means salary increases. I think that is an ideal situation where that will be, happy situation for the consumers, where the price increases are managed, and also for companies as well, that they assure profits for their businesses.
Having said that, Mr. Suan, how does inflation affect different groups of people? Who is most impacted by it? Who is not, and why?
Right. I think especially in a high inflation environment, for example, what we have seen for the last couple of years, I think those groups that are vulnerable to fast increases in prices, in consumer prices, are the lower income groups, and also those with fewer assets, or compared to those with higher incomes or more assets. So for price increases, because for those lower income, their salary increases may not be as fast, and their base is quite low. So when they have a high cost of living or price increases that are very high, that would affect their expenses, right? The way that they afford different goods. But for higher incomes, and also for those people with more assets, they are able to tolerate higher price increases because of the higher base of incomes, and also they have more ways to generate income, for example, through their assets such as property or stocks and shares. So the lower income groups are in general more vulnerable to, especially in a high inflation environment.
So as you said, high inflation, that has long been an issue for Singapore. What is your inflation outlook going into the new year then?
Okay, I think fortunately for those so-called high inflation, those inflation rate that we have experienced much faster than what we had seen before, I think those days probably are over, with today's number below 2% for the core inflation. I think going forward, going to next year, I think there's a very good chance that inflation will stay below 2% on average, for whether it's core inflation or overall inflation. I think we can attribute that to I think the government has done a great job in managing the cost increases by allowing more imports and by diversifying the imports, and also strengthening of the Sing dollar over the past few years. I think definitely have helped to mitigate or to reduce the pressures on import costs. At the same time, the supply chain has more or less coming back to normal compared to the pandemic period. So in terms of supply, I think we are not seeing the kind of days that what we had experienced with supply disruptions and those other really bad things.
All right, Mr. Suan, appreciate your insights. Thank you so much. Suan Teck Kin, the head of research at UOB.